In my view, gold and silver are not just commodities. They are real-time indicators of the broader macroeconomic system. Trying to understand their movements solely through short-term supply and demand misses the deeper signals the market is sending. Macro drivers such as interest rates, inflation, currency strength, and global debt dynamics are the real forces that determine the direction of these metals. By systematically observing these forces, one can anticipate when precious metals might have the potential to retest previous highs. When we think about gold and silver, many people treat them as just commodities, as if they exist in isolation from the rest of the economy. But the truth is far more profound. The prices of these metals are intimately tied to the very structure of the global financial system. They are, in many ways, mirrors reflecting the health, weaknesses, and imbalances in economies around the world. If you want to anticipate where gold and silver might go, you cannot just look at the supply of metal or demand from jewelers. You have to look at the forces that move the entire system: interest rates, inflation, currency strength, debt levels, and monetary policy. These macro drivers are what truly dictate the trajectory of precious metals, and understanding them requires thinking in terms of principles, not mere events. Interest rates, for example, are one of the most powerful levers. When central banks raise rates, it increases the opportunity cost of holding non-yielding assets like gold and silver. Investors tend to favor assets that provide income, like bonds or savings instruments. Conversely, when rates are low, or when real interest rates are negative, precious metals become more attractive because they preserve value in a world where cash loses purchasing power over time. This is why, historically, gold and silver often rally during periods when central banks are forced to maintain low rates to support economies under stress. The relationship isn't perfect or instantaneous, but over time, it forms a predictable pattern that disciplined observers can identify. Then there is inflation, which is fundamentally a measure of how much the value of money is declining. Gold and silver are, in a sense, insurance against that decline. When the purchasing power of currency is under pressure, people naturally gravitate toward assets that have intrinsic value and cannot be arbitrarily increased. What we see consistently across history is that metals respond to the erosion of confidence in paper currencies. They don't just move because of consumer demand or jewelry markets. They move because they are safe, haven instruments in a system that is increasingly complex and, at times, fragile. To anticipate a retest of highs, you must observe the signals that indicate rising inflation or eroding confidence in the monetary system. These are not short-term market noises. They are structural forces. Currency strength is another major factor. Precious metals are priced in dollars, and fluctuations in the dollar's value have a direct impact on their prices. A weaker dollar makes gold and silver cheaper in other currencies, which can boost global demand. Conversely, a strengthening dollar tends to exert downward pressure. But this is not just a mechanical relationship. It is reflective of the global balance of trade, capital flows, and geopolitical stability. Understanding these underlying forces allows one to anticipate not only where prices might move, but why they move. This is critical because markets often overreact to short-term headlines while ignoring these fundamental drivers. Finally, debt levels and financial leverage play a profound role. When governments and corporations carry high levels of debt, they become vulnerable to shifts in interest rates and credit conditions. Precious metals in such environments act as a hedge against financial instability. They are, in effect, a form of protection against the mispricing of risk in complex economic systems. Observing the accumulation of debt and the policies that manage it provides insight into potential surges in demand for these metals, particularly during periods of uncertainty. All of this underscores a simple principle. To anticipate gold and silver movements, you must think about the system as a whole, not in fragments. Each macroeconomic variable interacts with the others, creating patterns that are not always intuitive, but are predictable once you understand the underlying principles. Those who succeed in markets consistently are not merely reacting to events. They are observing the forces at work, evaluating probabilities, and making decisions based on a deep understanding of cause and effect. By focusing on the macro drivers, interest rates, inflation, currency strength, and debt dynamics, you gain clarity on when gold and silver might retest their highs, not as a matter of speculation, but as a consequence of predictable systemic pressures. In essence, precious metals are not just investment instruments. They are indicators. They reflect confidence, fear, and the health of financial systems. To interpret them correctly, you must think holistically, analytically, and in terms of long-term principles. It is this disciplined perspective, rather than short-term noise, that allows investors to position themselves advantageously and to understand not just what might happen, but why it happens. When we observe markets, we often focus on numbers, charts, and economic indicators. But what really drives prices, particularly in assets like gold and silver, is the interplay between fundamentals and human behavior. Markets are not purely rational, they are deeply influenced by psychology. Understanding cycles, sentiment, and crowd behavior is as essential as understanding interest rates or inflation. In fact, they often amplify or even temporarily override fundamental factors. If one wishes to anticipate movements in precious metals, ignoring the behavioral component is a critical mistake. Markets move in cycles because human behavior moves in cycles. Investors tend to oscillate between fear and greed, optimism and pessimism, patience and impatience. These swings are often predictable, even if the timing is not precise. When times are good and risks taking is rewarded, investors are eager to chase returns, sometimes ignoring underlying vulnerabilities. Conversely, when fear takes hold, whether because of geopolitical tensions, economic uncertainty, or sharp declines in other assets, investors rush to safe haven assets like gold and silver. This dynamic creates recurring patterns in price movements, which can be studied and anticipated. Cycles do not repeat exactly, but they rhyme, and recognizing the rhyme is a powerful tool. One of the most important aspects of market psychology is herd behavior. Individuals tend to follow the crowd, often amplifying trends in both directions. When prices rise, more investors enter the market, driving prices higher until a tipping point is reached. When panic sets in, selling accelerates, pushing prices lower at a rate that often exceeds the logic of fundamentals. Precious metals are particularly sensitive to this because they are both a store of value and a speculative instrument. In times of uncertainty, the psychological component dominates, creating sharp and sometimes dramatic price swings. Observing these patterns provides critical insight into when a market may be poised to retest previous highs or lows. Cycles are not limited to short-term market swings, they extend to long-term macroeconomic cycles as well. Gold and silver often respond to broader economic and financial cycles, including periods of inflation, deflation, and credit expansion or contraction. During times of economic stress, precious metals tend to perform well, reflecting investor desire for security and stability. Conversely, during periods of economic expansion and strong confidence in the financial system, demand for these assets may decline. By studying historical cycles, one can develop a framework for anticipating when metals are likely to rally or consolidate. This requires patience and a willingness to look beyond immediate events to the broader forces at work. Sentiment indicators provide additional insight into market psychology. Metrics such as investor positioning, speculative activity, and survey-based confidence indices reveal the prevailing mood in the market. Extreme optimism often precedes corrections, while extreme pessimism frequently signals opportunities. When many participants are aligned in one direction, markets become vulnerable to sudden reversals. Precious metals, being highly liquid and globally traded, are particularly responsive to shifts in sentiment. Recognizing these extremes can provide a strategic advantage for anticipating potential retests of prior highs. An essential principle is that psychology interacts with fundamentals to create trends, but it also generates noise. Short-term fluctuations often appear chaotic, driven by overreactions, rumors, or misinterpretation of events. Yet, within that apparent chaos lies structure. By focusing on the underlying cycles and understanding the behavioral tendencies that drive them, one can separate meaningful signals from temporary noise. This discipline allows for strategic positioning rather than reactive trading, aligning decisions with broader systemic patterns rather than short-term volatility. Ultimately, markets are a reflection of collective human behavior within an economic system. They are not purely mathematical constructs. They are living, breathing expressions of confidence, fear, and expectation. Understanding market psychology and cycles is not about predicting exact prices. It is about understanding the forces that consistently move prices in certain directions under certain conditions. Gold and silver are especially sensitive because they are both hedges and speculative assets, capturing the ebb and flow of investor sentiment more acutely than many other markets. By appreciating the psychological dynamics and cyclical nature of markets, investors can better anticipate movements, prepare for volatility, and identify periods when assets may retest previous highs. It is not about certainty but probability, about recognizing patterns and responding rationally rather than emotionally. Mastering this perspective requires observation, discipline, and a willingness to learn from history. When applied consistently, it transforms how one views markets, turning apparent chaos into a structured understanding of opportunity and risk. In financial markets, there are periods when prices move slowly, reflecting underlying trends and fundamentals. But there are also moments when sudden, sharp movements occur seemingly out of nowhere. These are the moments created by trigger events, specific catalysts that shift market sentiment and behavior in a dramatic way. For gold and silver, these triggers often determine whether the metals simply meander along or retest previous highs. Understanding the nature of these events and the context in which they occur is essential for anyone seeking to anticipate market moves rather than merely react to them. Trigger events are rarely isolated. They usually emerge at the intersection of structural conditions and market expectations. A central bank announcement, a geopolitical incident, or a surprising economic report can act as a spark, but the resulting fire is determined by pre-existing vulnerabilities. If inflation is already high, debt levels are elevated, and confidence in the currency is eroding, then even a relatively small event can cause disproportionate movements. Conversely, in a stable environment, even significant news may barely shift prices. This illustrates an important principle. It is not the trigger itself that matters most, but the structural context that amplifies or dampens its impact. Central bank actions are among the most influential triggers for precious metals. When policymakers adjust interest rates, announce quantitative easing programs, or signal concerns about economic growth, markets react immediately. Gold and silver, being non-yielding assets, respond to changes in real interest rates and expectations for future monetary policy. For example, when inflation accelerates and central banks signal that they will maintain accommodative policies, investors often rush into these metals as protection against the erosion of purchasing power. The combination of low real interest rates, monetary expansion, and economic uncertainty creates a fertile environment for prices to surge, sometimes to levels that revisit or exceed previous highs. Geopolitical events are another category of powerful triggers. Wars, sanctions, trade disputes, and political instability inject uncertainty into the global system. Investors respond to uncertainty by seeking safe haven assets, which is precisely why gold and silver often experience sharp rallies during such periods. It is not necessarily the direct economic impact of these events that drives prices, but the psychological and risk management behavior of market participants. When confidence in stability diminishes, demand for protection rises. Markets tend to overreact in the short term, and these overreactions create opportunities for disciplined observers to anticipate potential price movements. Surprises in economic data or corporate performance can also act as triggers. Inflation reports, employment numbers, fiscal policy announcements, or unexpected shifts in industrial production can recalibrate market expectations. When the data challenges prevailing assumptions, investors adjust positions rapidly. Precious metals, being sensitive to expectations of real returns, liquidity, and systemic risk, react to these adjustments. The important insight is that markets often anticipate these events in advance, pricing in expectations. When reality deviates from expectations, the reaction can be both swift and significant. Recognizing the potential for such deviations is crucial for forecasting price behavior. It is important to emphasize that trigger events do not guarantee outcomes. They are catalysts that interact with broader macroeconomic conditions and market psychology. They amplify existing trends rather than create new ones out of thin air. For example, if debt levels are manageable, inflation is moderate, and confidence in currency is high, a geopolitical flare-up may temporarily spike gold prices, but is unlikely to sustain a long-term rally. Conversely, if structural vulnerabilities already exist, even a minor event can ignite a movement that takes prices to retest previous highs. Understanding this interaction between triggers and underlying conditions is the key to anticipating significant price movements. Finally, one must recognize the value of preparation and analysis. Markets often move before the broader public recognizes the trigger or its implications. By systematically observing conditions that create susceptibility, such as debt accumulation, currency weakness, or rising inflation, investors can position themselves to respond strategically rather than emotionally. This disciplined approach distinguishes those who capture opportunities from those who are caught off guard. It is not about predicting exact timing or magnitude, but about understanding cause and effect in the system. Trigger events matter because they are the accelerants that transform potential into action. Gold and silver prices do not move randomly. They respond to forces that are amplified by catalysts. By observing these catalysts within the context of structural vulnerabilities and market psychology, investors can anticipate possible outcomes and prepare accordingly. This perspective turns uncertainty into a framework for strategic decision making, allowing one to navigate markets with clarity, discipline, and a deeper understanding of how seemingly isolated events can lead to significant consequences. In financial markets, it is tempting to focus solely on opportunities, chasing the assets that promise the highest returns. Yet, the truth is that opportunities and risks are inseparable. Every potential gain carries the possibility of loss. This is particularly true for assets like gold and silver, which can experience significant volatility in response to macroeconomic shifts, trigger events, or sudden swings in market sentiment. The key to navigating these markets successfully is not just identifying opportunities, but managing exposure in a disciplined way through diversification and risk management. Understanding these principles is not optional. It is essential for preserving capital and achieving consistent results over time. Diversification is the first and most fundamental principle of sound risk management. No single asset, no matter how promising, is immune to adverse conditions. Gold and silver, for example, may rally in response to inflation or monetary instability, but they can also stagnate or decline when conditions change. By holding a range of assets that respond differently to economic and market forces, investors can reduce the likelihood that any single adverse event will devastate their portfolios. Diversification is not about maximizing returns in a single period. It is about creating resilience across a range of potential scenarios. It is about acknowledging uncertainty and positioning for both expected and unexpected outcomes. Effective diversification requires a deep understanding of correlations and systemic interactions. Assets that appear unrelated on the surface may move in tandem under certain conditions. For instance, during periods of extreme market stress, traditionally uncorrelated assets may all decline simultaneously. Conversely, gold and silver often provide protection precisely because they behave differently from equities, bonds, or fiat currencies during times of uncertainty. Allocating capital with attention to these relationships allows an investor to balance risk and reward more effectively. The objective is not to eliminate risk entirely. That is impossible, but to manage it in a systematic and thoughtful way. Risk management is not merely about diversification. It also involves establishing frameworks for measuring, monitoring, and responding to potential losses. This requires discipline and the ability to confront uncomfortable realities. Investors often underestimate the magnitude of potential declines or overestimate their ability to predict markets. By setting clear rules for exposure, position sizing, and portfolio adjustments, one can maintain control even when markets behave unpredictably. Risk management is proactive, not reactive. It is about preparing for the range of possibilities rather than hoping for a favorable outcome. This mindset allows for rational decisions under pressure and prevents impulsive reactions that can compound losses. One of the most powerful tools in risk management is scenario analysis. By envisioning different economic, geopolitical, and financial conditions, investors can anticipate how gold, silver, and other assets are likely to respond. This is not a speculative exercise. It is a disciplined assessment of probabilities. What happens if inflation accelerates unexpectedly? What if central banks tighten monetary policy more aggressively than anticipated? What if a geopolitical crisis disrupts global trade? By considering these scenarios, investors can allocate capital in a way that is both protective and opportunistic, positioning themselves to benefit when conditions unfold in predicted or unexpected ways. Equally important is the recognition that risk management is a continuous process. Markets are dynamic, and conditions that were protective yesterday may not be sufficient tomorrow. Regularly reviewing portfolios, reassessing exposures, and adjusting allocations in response to evolving conditions ensures that a strategy remains robust. Gold and silver may offer hedging properties in some environments, but can also become correlated with riskier assets during periods of extreme stress. The disciplined investor acknowledges this and adapts, rather than clinging to assumptions or past performance. Finally, diversification and risk management cultivate psychological resilience. Markets are inherently uncertain, and volatility is inevitable. Investors who have structured their portfolios with multiple contingencies and protective measures are able to act rationally when fear or greed might otherwise dominate. They understand that losses are a natural part of investing, and that preserving capital in adverse conditions is often more important than maximizing short-term gains. By thinking in terms of probabilities, systemic interactions, and potential outcomes, investors can navigate markets with confidence, even amid uncertainty. Ultimately, the principles of diversification and risk management are inseparable from long-term success. They allow an investor to participate in opportunities while mitigating the downside, to remain disciplined in the face of volatility, and to capitalize on structural trends without being derailed by short-term fluctuations. In markets like gold and silver, where macroeconomic forces, trigger events, and cycles intersect, these principles are particularly critical. By embracing them, investors position themselves not only to survive but to thrive, transforming uncertainty into a framework for strategic decision-making and ensuring that opportunities are pursued with both courage and prudence. In the end, gold and silver are more than just investments. They are reflections of the health and dynamics of the global financial system. By understanding the macro drivers, recognizing market psychology and cycles, paying attention to trigger events, and managing risk through disciplined diversification, we position ourselves not just to react to the market, but to navigate it with clarity and confidence. The key is to think in principles, not impulses, and to make decisions based on understanding rather than speculation. When we do that, we are not just chasing short-term gains. We are building a foundation for long-term financial resilience and opportunity.